Let's talk some more about the markets. Our next guest says there are plenty of reason to be optimistic heading into September. Joining us is iCapital Chief Investment Strategist Anastasia Amoroso. So, Anastasia, welcome. Good morning. So, does this mean you're looking for more excuses to get into the market now versus excuses to get out in PCE?
Yes, excuses to get in. And look, the month of August has been a nice reset for the market. First of all, the fact that the 10-year Treasury is now convincingly above 4% and was there for the bulk of the month. That's been a big reset, just mentally for investors. And at the same time, we did have a pullback in the market. I know we would trace some of that again. But nevertheless, we've had a reset. And as I think about year end, I think about several reasons why I can be optimistic. The first one is the economy is heading into this, year-end period with substantial momentum. The third quarter GDP is on pace for 6%. That's a lot of consumer spending that is supporting the economy. The second point, whether the Fed pauses in September or not, I don't even think that the Fed is even restrictive yet. When you look at the neutral rate for the economy, the projected neutral rate, and where the Fed funds rate is minus core PCE inflation, we're maybe just now at neutral. We're maybe just now getting into slightly restrictive territory. So if that's the case, then there's no imminent recession that we have to worry about for the economy. And then the third point, I would say, again, the reset on the 10-year Treasury. But guess what? We've been accustomed to 10-year Treasury averaging 2.5% since the financial crisis. For years before that, it averaged 5.5%. And I actually think this is an economy that can function with this higher level of rates. So you put all that together, and that's what kind of gives me optimism that after the reset that we've had, investors should be stepping back in.
Okay, well, say I'm playing from home, and I believe you. I want to be optimistic, too, look for excuses to get in. What do I sell if I got to sell something to raise cash?
Well, I don't think you're raising cash necessarily, but maybe that's
cash
the move.
So that I can buy the things that I'm optimistic about along with you.
Right? Maybe, John, that's the move. Is a lot of investors have piled into cash, right? We know there's $5 or $6 trillion of cash on the sidelines and money market accounts, and I think that's what's going to likely happen is investors will gradually start working down those cash balances and buy things that have actually dipped. What I would be buying is the artificial intelligence theme and the stocks that have pulled back within that.
Pulled back with not a lot has pulled back. You got NVIDIA running near all-time highs, right? I mean, I see C3 AI has pulled back, but that one, jumps all over the place.
Yeah.
What kind of names are you looking at within that trade that you think are AI enough? Everybody claims to be AI, but AI enough and have also pulled back.
Well, so there's a lot of names in the AI beneficiary basket. And, it's understandable that semiconductors were the first stocks to sort of rally on this theme because they're the key enabling technology. We have to invest in compute. But if you look at over time, what is the biggest beneficiary of artificial intelligence? It's actually software. And it's software that's providing AI-driven, AI-enabled services. I mean, if you look at something like, $900 billion of total addressable market value, the bulk of that is likely to accrue to software companies. So I think you look at that. But the other thing I would say, John, just because NVIDIA, pulled back and is now, rallied quite a bit, and some of the other semiconductor stocks as well, what I would say, this massive potential of artificial intelligence is yet to be fully priced in. We're talking about a multi-year theme that's likely to generate trillions of dollars of economic value, that's going to generate hundreds of billions of dollars of spending on artificial intelligence. But guess what? The analysts are modeling that at a quarter at a time, and they're modeling that conservatively. And, the fact that NVIDIA came out and beat earnings estimates and then all the analysts had to raise their price targets, that's sort of the proof. So that suggests that the models are actually quite conservative right now.
It's more priced into NVIDIA than it is into some other things, I imagine, right? Because often there's this hero that comes out and everybody believes that is AI, but they ignore some other things that are going to benefit that they maybe haven't heard of.
Well, that's a great point, because when you look at earnings estimates revisions, and if you look at a company like NVIDIA, they have risen significantly because the company has guided. But if you look at earnings estimate revisions for kind of the rest of the AI beneficiary basket, whether it's first year, second year, third year earnings estimate revisions are up 1 or 2%. So that's what suggests to me that there's more upside to this theme, because as more and more benefits accrue to other AI beneficiaries, those earnings revisions will start to creep higher. And then you start looking at the stocks, and the PE multiple that we have today is not actually the PE multiple when those analyst earnings estimates become higher.